Topic examines stock price behavior and return distributions as the statistical foundation for equity valuation and option pricing models. Stock prices evolve continuously in response to changing economic conditions, investor expectations, corporate performance, and market sentiment. The topic explains that while stock prices themselves are generally modeled as log-normally distributed, stock returns are often assumed to follow a normal distribution under simplified financial frameworks. This assumption allows analysts to apply probabilistic techniques when estimating future price movements and investment risk. However, actual financial returns frequently exhibit skewness, excess kurtosis, and volatility clustering, indicating that extreme outcomes occur more often than predicted by normal distribution assumptions. The topic further discusses continuously compounded returns and their importance in financial modeling. Continuously compounded returns simplify mathematical analysis because they are additive across time periods and align naturally with log-normal stock price assumptions. The topic explains that expected returns and volatility are key statistical measures used to evaluate equity investments and derivative instruments. Volatility reflects the dispersion of returns around their expected value and represents one of the most important drivers of option prices. Higher volatility increases uncertainty regarding future stock prices, thereby raising the potential value of options. Consequently, accurate estimation of return distributions and volatility is essential for risk management, portfolio analysis, and derivative valuation. Topic also introduces the Black-Scholes-Merton (BSM) model, one of the most influential frameworks in modern financial economics for pricing European-style options. The BSM model assumes that stock prices follow geometric Brownian motion with constant volatility and continuously compounded returns. Additional assumptions include frictionless markets, continuous trading, no arbitrage opportunities, constant risk-free interest rates, and the ability to borrow and lend freely. Under these assumptions, the model derives closed-form formulas for pricing call and put options. The Black-Scholes-Merton framework transformed derivative markets by providing a consistent and mathematically rigorous method for valuing options and constructing hedging strategies. The topic explains that the BSM model values options through dynamic replication and risk-neutral valuation principles. By continuously adjusting positions in the underlying stock and a risk-free asset, investors can theoretically replicate option payoffs and eliminate risk. The option price is therefore determined by the cost of constructing this replicating portfolio, rather than by investor risk preferences directly. Several factors influence option values within the model, including the current stock price, strike price, time to expiration, risk-free interest rate, volatility, and expected dividend payments. The model also introduces option sensitivities known as Greeks, including delta, gamma, vega, theta, and rho, which measure exposure to underlying risk factors. The topic also highlights the limitations of the Black-Scholes-Merton model when applied to real financial markets. The assumption of constant volatility is often unrealistic because market volatility changes over time and may rise sharply during periods of financial stress. Asset returns also exhibit jumps, fat tails, and changing correlations that deviate from geometric Brownian motion assumptions. Continuous hedging is impractical because trading occurs discretely and involves transaction costs. Despite these limitations, the BSM model remains widely used because it provides valuable intuition regarding option pricing relationships and serves as the foundation for more advanced derivative valuation models incorporating stochastic volatility and jump processes. Topic also focuses on the treatment of dividends, warrants, and implied volatility within option pricing frameworks. Dividend payments reduce expected future stock prices because cash distributions lower firm value transferred to shareholders. Consequently, dividend-paying stocks affect option values differently from non-dividend-paying stocks. Call options generally become less valuable when dividends increase, while put options gain value. The topic also explains warrants, which are long-term securities granting holders the right to purchase company shares at predetermined prices. Unlike exchange-traded options, warrants are issued directly by corporations and may create dilution effects because exercising warrants increases the number of shares outstanding. The topic further introduces implied volatility, one of the most important concepts in modern derivatives markets. Implied volatility represents the level of future volatility embedded in observed market option prices. Rather than being directly observable, implied volatility is derived by solving the Black-Scholes-Merton formula backward using market prices as inputs. Because implied volatility reflects investor expectations and market sentiment, it serves as a forward-looking measure of uncertainty. Different strike prices and maturities often produce varying implied volatilities, creating volatility smiles or skews inconsistent with constant volatility assumptions. Traders and risk managers closely monitor implied volatility because it influences option pricing, hedging decisions, and assessments of market risk conditions. The topic concludes by emphasizing the interconnected relationship between return distributions, volatility estimation, and option pricing models in financial markets. Stock price dynamics provide the statistical basis for understanding derivative valuation and risk management. The Black-Scholes-Merton framework introduced a revolutionary arbitrage-based approach for pricing options consistently under specified assumptions. Dividends, warrants, and implied volatility extend the analysis by incorporating additional real-world complexities influencing market prices and trading behavior. Although modern financial markets require more advanced models to capture changing volatility and non-normal return behavior, the principles introduced in these topics remain fundamental to derivatives theory, portfolio management, and financial risk analysis.